Welcome to the 11th edition of our podcast series, Talking Data, which offers timely insights into macro data and its impact on the economy and markets. I'm Kristen Radish of Arbor Research and Trading, and I will be today's moderator. Our podcast features Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. Today we'll be discussing claims and jobs. U.S. unemployment claims remained elevated at 840,000 last week as the labor market flashes signs of a slowdown and more layoffs that are becoming permanent. Jim, there's one quirk in last week's data. Let's start off by talking about California.
Yes, and thanks. I did want to talk about this topic today because, at this point, everything about the reopening of the economy centers around the phrase we'll use is restoring jobs, not job growth, but getting the jobs back. And one of the more important high frequency statistics that we look at is initial claims. And as you pointed out, it was about 840,000 people filed for initial claims this week, roughly the same that it's been for the last couple of weeks. Let me give you the bottom line here. They can't count these numbers properly. The state of California has now reported exactly the same number for 3 weeks in a row. They have stopped reporting, and they'll just continue to use the same 263,179 number for claims every week until they sort through trying to measure it properly. They're afraid that there's massive fraud in the California unemployment program. I could tell you without looking at the data, the answer is yes, there is. And that they want to try and get a better handle on the numbers. Now, to give you a measure of what we're talking about, in the pandemic period, California has been 28% of all claims. Pre-pandemic, they were somewhere between 10 and 20% of all claims. So they've been a disproportionately high number of all of the claims right now. And I think that if you find that they go through and they eliminate the fraud in their program, that they're probably going to drop back down their historical norm. Now, that doesn't mean that the economy is magically better. That just means that the inaccurate number that we were looking at is probably a little bit more accurate at that point. Final thought, and then Ben, I'll drag you into this. One of the problems California is having is that their unemployment insurance state program is run under the programming language of COBOL, C-O-B-O-L, which was invented in 1959. There's like nobody that knows this prehistoric language, and they're desperately searching for COBOL programmers. I guess if they exist, they got to be 75 years old at this point because nobody knows how to use that program. Therein lies the problem with a lot of these old state programs. But Ben, let me drag you in. You got any thoughts on what I've said, maybe about the pandemic unemployment insurance program, the second program, or anything else?
Yeah, I think that, looking at what we can find in terms of tracking on a real-time basis, what's happening with unemployment benefits and individuals seeking them out, whether or not they have them, don't have them, and so on, will be our next topic. But if you do look at the search activity for unemployment benefits and kind of welfare in general, those have, kind of continued to drop since really middle of April. We had like a 12 to 14 standard deviation event. We're now somewhere around 4 standard deviations, still above average. But even California has continued to drop. And so for these other states, their claims have actually receded along with the search activity. California is an outlier. And so I think it kind of lends itself to what you said and maybe gives some potential evidence that yeah, California is likely going to adjust to the downside here moving forward. And California is a big kind of sore thumb. It's one of the worst states in a lot of our data, kind of granular data, because it is a heavy work from home state. And they've seen an absolute demolishing to the recruitment side of the job market. So it'll be interesting to see, without any kind of, I guess, help from the federal government, you get all of these people now potentially, having nowhere to find employment, and they don't have those benefits. That's going to have some kind of impact on the economy.
Right, and just to finish up this section before we go on to the next question, there is a separate program called the Pandemic Unemployment Assistance, the PUA. That is a federal government program that they put together and that's for sole proprietors and gig economy workers. So if you're a laid off Uber driver, or if you were a self-employed person, that you can apply to get unemployment insurance through that program. Now, that's a quasi-federal program as well too. And the reason I bring all that up is, according to the federal government, 7 million people are on the PUA program, but you apply through your state to get it. According to the aggregate of all the states, only 2 million people are on the program. So again, they've got a real serious measurement problem here that they can't get on the same page. And again, for us that are looking at the economy and looking at interest rates and looking at the stock market and wondering what it means for growth or earnings, these are kind of important questions to go, what is the true state of the economy? And right now, the measurements are really messed up. Kristen, how about question number 2? I think Ben's got an idea of how we can maybe measure what's going on with the economy around all of these numbers.
Sure. Ben, can you talk about the Google search in terms of jobs? Well, what are we seeing right now?
So, right. So the kind of corroborating some of the reduction we've seen in some of the consumer spending style search activity is we're seeing kind of a retreat in really what job seekers and recruiters are potentially doing in terms of entering into their Google search boxes. So on the recruitment front, those that are actually looking to post jobs or look for new employees have started to recede over the past couple of weeks, especially in the higher risk states, those that have current outbreaks. That could include the majority of the Central Plains, in Wisconsin. But really, that's been a story that's kind of been in place since really early July or so, and it's just only started to get kind of worse now, potentially with the end of a lot of the programs that the government has provided. We're starting to see some slowing in the Eurozone, and now we're seeing some slowing in the US economy. And then on the flip side, job seeking is something where we've actually seen take a step backwards, even in your lower risk states. So around this time of year, or really starting even maybe a month or two before, seasonal employment and hiring begins for the holiday season, and that is lagging. So if you look at Glassdoor, if you look at Indeed, the amount of job seeking for those temporary jobs just aren't there. A lot of it still remains permanent, those looking for permanent style jobs. But the fact is that both the recruiters and the job seekers, both sides of this here, are seeing diminishing activity, and that's also showing up in less job interview type searches. What should I be wearing? What kind of questions can I anticipate? Or maybe just general information about how job interviews go. Those type of searches have really plateaued over the past 1 to 2 months. So this is kind of something that's on the fence. And I think, like Jim was saying, bears some very close watching, because if this data gets worse and we start to see prints of 200, 100, or no jobs gains on a month-over-month basis, that's going to be very disruptive for. I think Jim was talking before we came into this. There's still 10 million jobs out there that are lost since the peak. We have a lot of wood to chop, and California is a great example. They lost 2.7 million jobs and only added 151,000, last month. So there's a lot of room to go, even though the numbers look fantastic on a month-over-month basis.
So Ben, I consider myself an Austrian libertarian kind of thinker, and my gut reflex normally is, if you say, hey, we need government assistance, the answer is no. Now you can tell me what the details are. But in this case, because the shutdowns were imposed by the government on the economy, I do think it is appropriate to have heavy government assistance. Just like I've used the analogy, when the government wants to take my house and my property and build a highway through it, that's for society, that's a worthwhile endeavor, but they have to compensate me for it. Well, it was understandable why we shut down the economy, but you took perfectly good businesses, you being the government, and shut them down, and you have to compensate people for them as well too. And I'm leading up to, I am of the opinion that the markets are correct in fretting or wanting or desiring fiscal stimulus this go around, more so than in the past. That in the past, if you saw jobs struggling like this, I would get on my Austrian soapbox and say, you got to let the economy sort itself out. But this one was kind of a self-goal or self-own or something like that. What's your thoughts about all of this, about where we are on the need for fiscal stimulus and whether or not we're going to get it, should we get it, and the like?
Yeah, I think there's for me, there's little doubt that investors believe the fiscal policy story has all of a sudden become very important. So how you can do that is you can look at the correlations of returns or changes. For example, in the US 10-year note to TIPS break-evens, to small cap stocks in particular, and all the way out to high yield corporates, and the correlations to fiscal policy sentiment on a day-to-day basis, which we can measure via television news and other fancy ways, those correlations have done nothing but move up since the FPUC payments ended in the end of July, and they really started to accelerate over the past 2 weeks. So I think this kind of concern and discussion about fiscal policy, Trump taking it, saying yes, saying no, is impacting markets on an intraday basis, maybe not wildly, but I think going into the election and then after the election, this is going to be a critical story. We have a lot of states and municipalities that are going to need funding and need support, and they're not going to be willing to lever up and get themselves through potentially January or later without some assurances from the government that there's going to be that support, or else things do get dire. You have to remember last month, 182,000 jobs that were lost in the public sector, and that's kind of why we saw some of the diminishing job gains last month was due to that public sector hit, and that's something that could get much, much worse without this fiscal policy. So I 100% agree. The government, is what shut things down. And investors agree that there's a solution here, and that's more fiscal stimulus, and that's why they've attached themselves so much to it.
One more question before we move on to our final bullet point, and that is September 30th was an important date. A lot of the PPP, the Paycheck Protection Plan 1.0 loans were stipulated that you couldn't lay off anybody until September 30th. The airline bailouts and a lot of other bailouts where you couldn't lay off anybody till September 30th. That date has come and gone. we're talking now in early October here. And Nancy Pelosi's even told the airlines, hold on, guys, don't lay off anybody. We're working on trying to get you a deal. Hold in place here. If we get no fiscal stimulus at all, could you hazard a guess of what we're going to see in terms of another round of layoffs, or what we might see in unemployment right now?
Yeah, I don't know exactly, where we would go, but I think, with the kind of scary large, thousands, tens of thousands in the airlines case, between United and 31,000, right? Allstate, I think 2,000 or 4,000. So, I think the layoffs would indeed continue. And I think that's what the Federal Reserve, we put out a chart that got really popular yesterday, showing how much the Federal Reserve is talking about layoffs the most by multiples, even relative to the great financial crisis. So I think that the threat is there. And I think without the fiscal stimulus to tide over states and their municipalities, keep them from suffering dramatic job losses, and to keep smaller businesses, medium-sized businesses going, and keep them employing individuals, I think they're going to need that. And again, if you look at all the equity market, the small cap stocks, the Russell 2000 is what's most attached to this fiscal policy story. And they're the ones that are, currently, I think, most at risk. And that's where some of those drawdowns could occur if we don't get the fiscal stimulus that we are all pretty much kind of expecting.
Yeah, I've been expecting it since August, and I still expect it as well, too. Kristen, how about our last bullet point?
Yes, Jim, why don't you walk us through the reopening? We've noticed some slowing that's going on now. Back in June, the consensus was expecting a massive growth quarter, but where are we at now?
Yeah, so the way I've tried to measure it is we know, let's talk big picture. We know the second quarter GDP was minus 31.7, the worst quarter in American history, and that's because that was the shutdown quarter. We know the third quarter is going to be the reopening quarter, and the estimates are for plus 28% on GDP, the best quarter in American history. Just ask the president. He's well aware of the fact that the Friday before the Tuesday election, 4 days before the election, that GDP number will come out. And I'm sure he's going to have a Rose Garden ceremony to herald it right before the election as well, too. So put those aside. That was the shutdown and the reopening. Let's look at the fourth quarter. The fourth quarter, which we're only a handful of days into right now, maybe give us a truer picture of where we are in the economy. Well, back in June, economists, the consensus of about 70 economists that Bloomberg regularly surveys was 11% growth for the fourth quarter. That's booming growth if you were to get it. That number has consistently come down every week. It's now 3.5%. 3.5%, it by itself is a decent quarter, but it's been going down every week, and there's no assurances that it's done going down. Reminds me of the old joke about the window washer that falls off the 10th floor. Scaffolding, once he's safe, when he passes the 3rd floor, so far so good. Is this number keeps going down and down and down. There are some economists out there that are whispering that it might be a negative quarter or a zero quarter for the fourth quarter. So the economy has been dramatically slowing after the initial reopening surge, as Ben was talking about. So a lot of the high frequency data, open table, home base, the mobility data suggests that things kind of stopped getting better around July. Now they're not getting worse, but they're not necessarily getting better. And to that point, let's talk about jobs. We lost 21 million jobs when we shut down the economy. That's the non-farm payrolls decline. Since the restart, we have now gotten back about 10 million of those jobs. We're roughly 11 million short of where we were pre-pandemic. But the monthly payroll number 4 months ago was 1.4 million jobs for the month, then 1.1, then 900,000, and the September number was 660,000. So every month that number's going down. We need to get 11 million more jobs in order to say, okay, now we've offset the pandemic, and we've gone in the last 2 months from 900,000 growth to 600,000 growth. And as we've been talking about, there's signs of more struggle. We're talking many years with an S on the end of it before we see a recapture of all of those lost jobs. This is going to be a slog for the economy as we move forward from here. And I think it will continue to be a slog as we move forward. Ben, you got any thoughts on that?
No, yeah. So we are able to forecast out typically, kind of nowcast or forecast the payroll numbers as well as retail sales. And so retail sales, for example, in September, I think the medians, I haven't looked in the past couple of days, but somewhere around a 3 to 4% gain. And a lot of the indications that we're getting with the slowing in the consumer activity towards the end of the month suggests that we could see a print that's closer to flat on the month, which would be a big surprise. And I think that October is kind of shaping up similarly. And then on the payrolls front, I wouldn't be surprised to see in October, based on these forecasts using the recruitment, job seeking, and so on data, to see a print somewhere right now. It's showing around 300,000 jobs that we would potentially add in October. And that's, again, just as Jim said, those aren't the prints we need. If we continue to see the stair step lower and lower, it's going to take a long time for us to recoup those losses. And I think there's some stress that's now brewing out there. One place that we can see it is we have an increasing amount of searches for installment loans and payday loans, which are very scary type of leveraging up and loans that carry just humongous interest rates for individuals, but really across the board. And in particular, the Northeast and the Southeast are seeing these increases for fast cash. And that's usually a sign of duress. And again, that comes right after those FPUC payments and the September 30th and all of these kind of government programs slowing down. So there's a lot to watch here. Like Jim said, it's not dire. It's just that we're on like this fence right now, and we could go one way or the other, and fiscal policy would potentially kick us the right way. And that's what we're all waiting for.
I'll just add before we go into our final bullet point here about anything else, that the next payroll report will be out 2 days after the election. So we've gotten the last payroll. Of course, we won't pay attention to it because we'll be mired in some kind of recount fight then at that point, and that'll be a podcast for a couple of weeks from now as well too. Kirsten, last bullet point.
Yeah, so I'm going to turn it back to each of you just to give a final recap today on your thoughts on this topic.
Ben, why don't you go first?
Sure. Yeah, so I think that there's indications that the consumer slowed over the past 1 to 2 weeks. Obviously, we've plateaued really since July, but we've still had plenty of quality data and some positive momentum. So it's not like we are in a economic recovery. It's just a matter of how much faster can that go and how much longer can it last. And I think the job market is a critical situation here. And I think that if it does deteriorate, there's obviously a major negative. The only positive would be that if we do get some strong indications, and might take till after the election, as Jim said, that would help push along fiscal stimulus and get that going, because I think that is a critical rung here. Now, I think markets are a little bit over exuberant, thinking that fiscal stimulus is going to, kind of help in the very near term. I mean, it's possible that we don't really see much of this for months. And I think that's something that we'll all have to come to grips with here in the not too distant future, especially as markets and investors, so on correlations have risen to the fiscal policy story, fiscal policy uncertainty story.
Yeah, I'll just conclude by emphasizing the same type of thing. We're not getting worse, but we dug such a deep hole, and we're still in the hole, that you want to be moving a little bit faster to get out of the hole. And that's really what the concern is that all of a sudden the pace of getting out of the hole is slowing. It's not reversing. We're not getting deeper in it yet, at least not yet. But I think that if we don't start to see, either through fiscal stimulus or something else to stimulate the economy, maybe a medical bailout with a vaccine or something like that, that the next story might be, and this would be a post-election story, is a frustration building in. Okay, we're getting better, sort of, kind of, but boy, this is taking a long time, and I don't have a lot of more time that I want to just sit around waiting for normalcy or waiting for better job opportunities to show up as well too. So that's why I agree with Ben. We got to get going here. One way, either we're going to get going and start getting out of this hole, or we're going to start realizing that we're going to be stuck in it for a while, and that's going to have consequences as well too. Thing is, we're talking roughly 3 weeks before the election now, that that story's, whatever the story's already baked in for the election, is probably going to be a post-election story.
Thank you both for your time and your thoughts today. We really appreciate it. And thank you for our audience for joining us. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm that produces innovative research across a broad range of fixed income, equity, currency, and commodity markets. Bianco Research and Arbor Data Science are our two most prominent research offerings. For further information on Arbor Research, Bianco Research, and Arbor Data Science, please contact Gus Handler at gus.handler@arborresearch.com.